Please remember that futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I author in my weekly written reports. Prices shown on charts and quote bars are in real time and take into account all known activity up to this point in time. If you'd like to read more of this disclaimer, simply hit the pause key on your computer screen. Welcome traders, I'm Boyd Baker, and thanks for tuning in to a second of a series of options tutorials. In the first tutorial, we covered the basics of options trading. What is a put, what is a call, and what is the premium, or the cost of the option to you if you're going to be a buyer of an option. Today we wanted to talk about strike price relationships. And what do we mean by a strike price? Well, a strike price is simply the specific price that you as a option buyer have the right to be long the underlying futures when you're buying a call, or the specific price that you have the right to be short the underlying futures when you're buying a put. Now, these relationships of the strike prices to the underlying futures can be termed in three different ways. They can be called in the money, at the money, or out of the money. Now, each one of these is going to have its own unique relationship in price based on where the underlying futures is. I think one of the best ways to look at this is let's look at a gold chart and the relationship of these options based on where the gold is trading. Right now, gold is trading at about $1,250 an ounce. If you're bullish the gold market and you wanted to buy a call, if you bought an at-the-money option, you'd be buying a strike price right here at $1,250. There are $1,250 calls. If you wanted to go out of the money and buy an out-of-the-money call, you'd be looking at a $1,300 call, or maybe even higher up, a $1,350 or $1,400 call. If you wanted to buy in-the-money calls, you'd be looking at options that have a strike price lower than the underlying futures. So an in-the-money call might be a $1,200 call, or even further on down, like an $1,150. Now, the exact opposite is going to hold for when you're buying puts. The terminology of at the money is going to be the same, and at the money put is going to be a $1,250 put. But if we're going to buy an in the money put now, that's going to be a strike price which is higher than the underlying futures. So the $1,300 put is now in the money. The $1,250 put, that's at the money. And if you feel that gold prices are going to work lower, you'd be looking at something like a $1,200 put, or maybe lower, an $1,150 put, or further on down. Now again, each one of these options has a different relationship and different price to the underlying futures. As a general rule, an at-the-money option is going to be moderately priced. When we're talking in-the-money options, these are going to be more expensive because you have the right to be short if you're buying a put at a higher price. If you feel that gold's going lower and you wanted to buy out-of-the-money puts, these options are going to tend to be less expensive. So if you have any questions on this, I'd be happy to cover this for you. Again, feel free to call me here at 866-973-2079.